Where do you think multifamily cap rates are going to be at the end of this year and then into 2023? That's what we're going to be talking about this week on The Gray Report. We're going to be talking about not only that, a survey from CBRE on cap rates, but reports from institutional property advisors, apartment list, apartment guide, so much more, some original opinions and commentary. You don't want to miss it. We'll see you on The Report. Back on The Gray Report.
That's right.
Matt, how's your week going, man?
It's good to be back. Fairly no big events.
Yeah.
Fairly uneventful, but there's been a lot of chance this week, especially in the reports that I've seen, of people kind of taking stock of things and figuring out where are we at, where are we going. Kind of a realization that we may have been at a turning point earlier, but we're going to have to get used to this kind of situation where we don't know where we are. Yeah. I heard the CBRE report said the word turbulent a whole lot of times. So I think that may be what
I think turbulent. That's a pretty good description of the past couple months and probably the months to come. Did see Jerome Powell speak out in Jackson Hole at the symposium they do out there. Sent some fear through the markets. I don't think we really learned anything new though. But definitely
he didn't get to say any new numbers for interest rates, but he's got the people right where he want them. Got them worried, and I like it.
Again, I think they're using this monetary policy forward, which is like psychology, and just by expressing opinions and just putting information out there. They don't have to actually adjust interest rates or buy securities. They can just can move the opinions and the psychology of markets that way. I think it's almost more effective.
It's more fun.
It is more fun, and the media certainly likes it.
Yeah.
Man, we've got some really good reports. So many people want to know, and nobody has the answer, but we have some data to look at on kind of where the market is going in terms of cap rates. We're in a higher interest rate environment.
Yeah.
I mean, you look at, the 10-year Treasury, we're above 3%, kind of 3.1 on the 10-year Treasury. The 2-year has been even higher than the 10-year Treasury. The Fed funds rate has been rising as the Federal Reserve is raising that lower rate. That obviously affects the cost of borrowing and how much leverage investors can use. And typically there's some, not a direct correlation, but some kind of correlation between interest rates and at least some bond yields and cap rates, whether you want to look at the 10-year or the 2-year, or you want to look at high-yield corporate bonds, which I think the evidence points to that they are a little bit more of an analog to cap rates rather than Treasury bills. But cap rates haven't moved up that much compared to other rates. I mean, I think anecdotally we're going to look at these surveys. We've seen some movement upwards in cap rates, 25, 50 basis points in some markets. But we're also seeing a lot of assets still trade and go under contract at very low cap rates, kind of in the mid fours, even sub fours.
Yeah, it's interesting in the rush, and this is kind of skipping a little bit ahead, and we'll get to it later. But it's like the raising interest rates is creating this rush in sales volume to get ahead of the next rate increase. But that's kind of, in some sectors, it's driving cap rates down a little bit because there's so much more people rushing in.
Well, and also trying to, try to harness some of this rent growth and inflation that we're still seeing.
Yeah.
Well, we're going to get into that. But first, let's talk about more of the residential housing market, single family homes. We've been talking about this, quite a bit. As, again, interest rates have risen, the cost to buy a home and what an individual can afford in terms of a mortgage payment, a lot of folks that just can't afford to buy a home anymore.
Yeah.
That hasn't shown up in prices, though. We're still seeing price increases, albeit flat. Inventory is at, very high levels compared to last year. I think, we're at inventory levels closer to 2009. So a lot of slack's being taken out of the system. But so are we on the precipice here? Or, are we already seeing the bottom? Are there still buyers in the market?
You can look at the chart of the Case-Shiller, and I think it's actually really instructive just to take a look at this. And it's on the Fred website, and it doesn't have the most recent number for the most recent month that was just announced yesterday, but it does have the general trends. And yes, there is a dip during the Great Housing Crisis, but there's no real precipice here. You can you can mess around with a chart and make things look as steep as you want to, but any movement in the housing market is something that is going to be months, if not years, in developing.
Yeah.
And it's kind of irresponsible to say that there's going to be an impending collapse. Last week I also said that we're not facing an impending housing collapse, and I'm a little worried that I'm have two rose-colored glasses. I kind of think like I'm the people that are laughing at Noah in the Bible as the rain was starting to pour out. But I'm going to take the risk and say that at this point, it still doesn't look like everyone's going to be underwater. See, I'm trying to continue.
Yeah, I see that.
Underwater mortgages, really? I can guarantee, though, that the prevailing opinion on home prices is that they're still really high.
Yeah.
And we're not at that point where people are bemoaning the loss of their home value. Right now, I think, and this is what we were talking about earlier, people are comparing to 2021, whether it's in the commercial real estate markets or in the home buying markets. A lot of people's opinions and perceptions of the current status of the market is comparing to 2021, and 2021 was such an aberration, whether it was low interest rates or incredibly growing home values, growing rents, and like we're normalizing here. It doesn't mean we're going back to apocalypse.
No,
we're going to apocalypse. We're not.
I totally agree with that. I think it's much more normalization, but also think about something like the backstops or just with kind of who has been buying homes and recently as opposed to back in 2006, 2007, and just the shape of those buyers. I mean, not a lot of adjustable rate mortgages. Most of them are kind of fixed rate. A lot of people locked in interest rates over the last couple of years when interest rates were very low. They don't need to sell. Why would they sell? I mean, the only reason why they would have to is, if they lost their job and there's a recession and then they have to sell. So I still think that there needs to be, for it to see any kind of meaningful decrease in the housing market, you're going to have some other economic event that really is affecting incomes, their individuals' ability to actually pay those mortgages.
Yeah.
So other than that, I mean, you still have people that want to buy a home. There are a ton of investors that are buying homes. The Blackstones, large hedge funds and other groups are just buying single family homes, turning them into rentals. They're getting the rental income. If the price of that home decreases a little bit, typically those strategies, they don't need to sell them. They're buying them for cash flow.
Yeah.
So, as long as they're cash flow positive, they don't need to sell. Rents are strong. There's a pretty wide margin of kind of break-even occupancy and what they have to, actually produce to be able to pay the mortgage. So, there's not like there's the recipe in this house of cards, at least in housing, that, just you pull one leg out, it's all going to come tumbling down. Now, can we see some moderate corrections? That makes sense because the cost to borrow is so high and we are out of whack.
That's what people are trying to do right now. Yeah, exactly. It'll come down. It's supposed to, or at least that's what Powell wants.
Yeah.
But it's not. Yeah, there is nothing inherent, and that's another thing too. Is and what I said last week. A collapse implies that there is something inherent and fundamental to the housing market itself. Right now, it's being acted upon, or at least the home buyers are being influenced by higher interest rates.
Yeah.
And I was saying again, people are comparing 2021 and 2022. Maybe that's a perception, but there's also a budget issue of if you locked in that rate, like you said, in 2021, that's really low, and you've got to get a much cheaper house in order to.
You just won't move.
Yeah.
You're just going to stay put.
It's totally going to turn the dial down in terms of sales volume.
And again, this all makes renting that much more appealing to so many more Americans. We talk about that every week, but it gives rents quite a bit of room, quite a bit of runway to continue to move because there's that difference between your mortgage rate and average rental rates in the United States right now.
Yeah, and so, and again, this may be a rose-colored glasses kind of thing, but the interest rates are a temporary phenomenon, and maybe they'll keep going up forever. I don't think so. I think that there's going to be a certain point where interest rates are going to start to come down, and that and that kind of precludes any possibility of an apocalypse if this is the one thing that's really dominating the market.
Well, we always have to keep in mind that the federal government doesn't want interest rates to be too high. The dollar is strong right now, which is a benefit, but there's a lot that's required to service the debt of the federal government. But now tax revenue is at an all-time high also, so they're getting tons of revenue to be able to pay some of that debt. So they are making it up on the revenue side, but there is a point where the government's going to much rather prefer the easy money, just like Wall Street, just like investors, just like most of the economy.
Yeah, no, I think that's a really good point.
And also, just last thing on the Case-Shiller index in home prices, that we always have to remind ourselves that housing is a very seasonal business, and you would always expect there to be a slowdown in the housing activity, sales, rent, and rental activity this time of year. Kids are going to school, people are at work, getting busier, people just aren't moving around nearly as much. So you would expect some flattening or declines in the winter.
Yeah, that's good. That's a good point, and that's something that I noted in some of the other reports that we had on rentals as well.
Awesome. Well, let's go to this Institutional Property Advisors report, Multifamily Market Intelligence. I always look forward to these reports, Matt, and I think this is one that is kind of packed full of good information.
It's a nice, tight little 4-page report.
Nice, concise.
I was like, oh man! And so they've got 6 key takeaways, and really all 6 of them is like, ooh, this is some juicy topics that I could, I could talk a whole hour about each one. One is rent growth is returning to normal levels. Maybe they were watching it when I have said for the past 4 weeks in a row, don't call it a cool down. It is normalizing. The next one is that the uptick in vacancy is not majorly cutting into rent growth. The next is that rent growth for renewals is mitigating the rise in expenses. And they also talk about how apartment construction is more active, but completions are hard to come by. And finally, next is the downtown apartment market coming back, but not necessarily the office market. And finally, that capital markets disruption to investment should become more apparent. This is, I think that last point is particularly interesting because we have seen relatively high sales volumes in 2022 so far, and I wonder what is going to happen in this higher interest rate environment.
Well, I think that's a good point, and one thing that I think we've mentioned a little bit in the past, but not too much, and I think it needs to be kind of highlighted is, and a lot of our listeners may be aware of this, but may not know it, is that a lot of groups out there in the kind of the multifamily syndication space that aren't necessarily utilizing institutional capital, many of those groups have largely been taken out of the market this year, and that's because of capital market conditions. With low cap rates and high interest rates, you need to have enough income on an acquisition of a property to be able to pay the debt service and then have a margin of error, beyond just paying off your mortgage. Typically, lenders are looking for a 1.24 to 1.3 debt service coverage ratio. And so you need to have 120% of cash flow to cover 100% of your debt plus 26% beyond that to be able to qualify that you have enough income to support the loan. So
you show them this is the income that's coming from rents. It's going to make this, and then they
exactly. So you got call it $100,000 of your mortgage payment. You need to be showing that you're making $126,000. So I can use the $100,000 to pay the mortgage, and then I've got $26,000 extra, in clearance because 1 month you might have a downturn or a high vacancy. It might go up and down. So you need to have some margin of error. They don't want you to loan you an amount where you'll just barely be able to cover the mortgage. So as interest rates rise, that debt service increases, so it's a harder threshold to clear. And so they will lend you less. They'll still give you a loan, but instead of giving you 75% of the loan to value, now I can only give you 65% or 60%. And there are some groups that were accustomed to getting 85% loan to value.
Man.
And 75 was, close to I think the average was probably, 72 or 73, because there's a lot of institutional capital out there. A lot of institutional investors prefer using less leverage. It decreases your return, but it also decreases risk. The risk tolerance is lower. They're not looking for knock it out of the park. They don't need a home run. They're looking for singles and doubles. Safe place to put their money. It's tax efficient. It's going to generate some income. So they're already accustomed to using relatively lower and moderate leverage, 50 to 65%. That's all you can get. So the buyers have been the big groups. There's been a lot of big portfolios, big deals have traded. A lot of it is institutional money or investors that are sophisticated enough to understand the trade-off of risk and return. I'm still wanting to get allocated to the asset class that has the most potential for return overall, that's getting us still a real positive yield, but you're just not getting the And again, those home run returns that you could have gotten with higher leverage. But higher leverage means higher risk as well. So there's a lot of groups, again, that are kind of in the middle market doing smaller deals. They can only raise so much equity. And at 60%, 65% loan to value, that could mean another $1 million or $2 million that you have to raise.
Yeah.
That's more of your equity. Your return is based on the total amount of equity. So again, it's harder to raise all the money. And it's also the returns are lower. And as returns lower, it becomes even harder to raise equity. So it's harder to raise and there's even more to raise.
Wow. Yeah.
So there's a lot of groups that have, trying to do deals, but are just struggling to do so. And so if you're a, active investor in multifamily syndications, you may have seen a slowdown in deal volume. Now, there's also uncertainty and other reasons to be, a little more cautious in doing deals. We haven't had as many deals this year as we thought, although I think that's changing as we've got a really good pipeline. But there just hasn't been that price discovery to kind of know, where everything is.
Yeah, that's interesting. I think that some of their comments on, some of the comments on any of these key takeaways are really interesting.
Yeah.
And it's stuff that we've really talked about, how apartment construction is active, but, it's going to take some time. We've seen
the cuts in projections of deliveries has been astonishing. I mean, we were up at one point they were predicting 500,000-600,000 deliveries this year, and what are they saying now?
Just over 400,000 units. Yeah. That's really interesting because it's like we were, what did it say? Properties authorized by building permit during the year end June totaled 666 units, up 28% year over year. We're permitting them, maybe even starting them, but they're not getting finished. And we have talked about this for a full year, that these timelines are going to be increased, and that's going to further keep demand high.
I mean, the supply is going to be delivered eventually at some point.
Yeah.
But it may just be more spread out over time, and as we've noted also, that it's concentrated across a handful of markets.
Yeah, and that's another good point too. Is any of these supply issues it's really, really important to look to local markets and the markets you're into, really even the submarkets, because that's where that's going to make an impact.
Yeah. Well, I would check out the rest of this report. Again, it's very concise. Just checking out these 6 takeaways. Takeaways that we've discussed quite a few times on the Gray Report, but it's always great to get some new data points to sink our teeth into. Matt, let's move on to this apartment list report for August of 2022. The national rent report. And again, one of the reasons why we like to look at all these different reports is sometimes the data is a little bit different.
Yeah, this is
and Matt really likes to track some of that. Yeah, so it's different, same reports but different data.
You can kind of get a feel, an apartment list. I've been following it for about 2 years, if not more. And you get a feel, okay, this apartment list is generally a little bit higher, it seems like, than some of the other reports. But it is consistent, and so you kind of know what you're going to get. So basically, this report says that rent growth is continuing to moderate, but it remains at elevated levels. It feels like I've said that every month this year. And as Apartment List explains in the report, they say that year-over-year growth has slowed to 10%, down from a pearl of nearly 18% at the beginning of the year. That's what they wrote.
Wait.
And they wrote pearl, and so I photoshopped a little pearl on one of their graphs there. But that's neither here nor there.
Down from a pearl. So that's not a figure of speech. Yeah.
No, the K is next to the L in the alphabet, so I think they probably maybe that makes
yeah, good stuff.
Anyways, so year-over-year growth is slowed to 10%, and then the month-over-month numbers are 0.5%. So that's what the month-over-month rent growth is, and take that over 6%. Take that over 12 months. It's still 6%, which is still well above historical averages. August is also at the end of peak renting season, and if you look at 2019 and 2018, these pre-pandemic years saw rent growth near zero, or even really in the negatives.
Yeah, negative. I mean, in 2020, 2020 is not probably a good year, but 2019 and 2018, they really started in August. Yeah. Well, 2018 started in August, and 2019 August was about almost flat, and then with a negative in September. Again, just seasonality, what to expect we just discussed earlier.
Yeah. So vacancy actually is a little bit different. Vacancy was so very low in October 2021. That was the real low point at 4.1%, and it has been inching up ever since. Ever since that day, or ever since that month in 2021, October, vacancy has been increasing. It's up at 5.1% now, so it has not been increasing dramatically each month, but it has still steadily been going up. And this vacancy trend is out of step, I think, a little bit with seasonal trends, so it's been more difficult to see where we're going right now. Now, this 5.1% vacancy is a lot lower than the recent peak vacancy of 7.2 in July 2020. And it's also way below where vacancy was pre-pandemic, which was around 6%, maybe a little bit above. So I think that, again, it's like we're not in 2021, but we're definitely doing better than any time pre-pandemic. Unless you've got blinders on and you can only see last year, you should really be thinking about how well things are going. And I
mean, I think what makes sense to me on the, it's a strong occupancy numbers, still well above, 200 basis points, better than kind of the closer to the historic average or kind of pre-pandemic, 100 basis points off the all-time lows. But again, people are being driven into rentals, not people are buying houses. But I think we're running into some, price growth issues of just demand destruction in the form of people can only afford so much in rent.
Yep.
And in some sectors, you're running into those ceilings, and we're going into the winter months. You're kind of moderating your rents.
So in previous months, I've heard that Class C was having trouble with kind of rent growth. I think that Class A and B are now having a little bit more trouble, so it's slowing down a little bit on the higher end apartment side. But I think that all of them, if inflation is a concern, there's going to be a ceiling unless wage growth starts to come. But then again, you run into inflation issues.
And I think we're seeing that. I mean, we are seeing wages rise, albeit not as fast as rents. But again, I think we see rents move before we typically see wages. But we are seeing wages. But we're also seeing some job losses. I mean, overall job gains as a nation, but in some select sectors of higher paying positions, a lot of tech companies, we are seeing layoffs.
I heard I've read about there's some prop tech companies
I think Snapchat today announced they were laying off 20% of their workforce, kind of doing a reorganization. So and that's not the first tech company that's announced major layoffs.
Yeah. So, and we actually, we covered this, I think, about a month or two ago, how these fast growing, we're kind of shifting in a little bit away from the growth into the kind of more value market. I do want to talk about these individual markets that they have here. Yeah. We're seeing a continued post-pandemic trend in the recovery of a lot of markets that had the most sluggish rent growth in 2020 and 2021. Seattle, New York, and San Jose were some of those higher cost of living places that stagnated during the pandemic, but they're making up for it now. Among the markets with the slowest rent growth, they actually, I'm sorry, to stay with the fastest rent growth, Rochester is doing incredibly well and has done well, over the past 12 months, over the past 6 months, really since March of 2020. I think that's really interesting.
I have a friend who lives in Rochester, and he worked for the Mayo Clinic there, and he's told me multiple times, he's like, you guys need to get into Rochester because the growth here is pretty incredible. Wow. A lot of that's driven by Mayo and then some of the surrounding, healthcare services. But so it makes sense. What are some of the slowest growing metros?
Among the Minneapolis. We've noted it before. That is a market with some of the slowest rent growth in the nation during the pandemic, over the past 12 months, and the past 6 months. Really, any way you slice it.
It's a pretty good example, though, to keep in mind. I mean, one state, pretty different stories between Minneapolis and Rochester.
Yeah, and there, there's a similar climate, I think, right? They're about the same latitude.
I think Minneapolis had all the issues with the George Floyd protests. There's a lot of issues. I think, and Minneapolis has also had some rent control. There's all kinds of issues. It's also cold, but again, Rochester is cold as well. Yeah. But Yeah.
So the conclusion of the report, and they kind of wrap things up, it really does line up with a lot of what I've been thinking, in that demand is still elevated considerably compared to historical averages, and a seasonal dip in rent growth this fall should not be taken as a sign of future collapse. As confident, though, as I am in the continued stability of the apartment market, I'm also confident that if rent growth dips later this year, people are going to say that all is lost. We'll see YouTube thumbnails with flames in the background and the words "Rent Disaster 2022" in like kind of diagonally photoshopped in the background. Someone disappointed someone's got their head saying it's like, "Oh, rent disaster," and then and that's what you'll see.
I think we've already seen it. It's like they're perennial.
Yeah.
And so Matt, this is where the pearl is.
This
is where the pearl
so
of
that
rent
is
growth.
Yeah, the pearl of rent growth right in July of 2021.
Okay. That's great. That's great. Okay. Apartment Guide. Let's talk about Apartment Guide. New report. Quarterly average rent price report. Again, we're going through all the data today. So
yeah, the keyword here is quarterly, and the numbers here square with of the Apartment Guide report squares with a lot of other reports. But I'm including this because whenever I get two of these regular reports that come in, that's an invitation for me to talk about, compare them.
Yep.
And it's an invitation to really point to some of the things that I think about when I'm assessing a report. Period.
I think that's kind of it's kind of inside the report, and we get a lot of questions about this. I do. It's like, how does Matt put all the reports together? What do you show? What to not include? So this is good. There's some interest in this.
Some reports get a little picture. Some reports do not get as much attention, and then they're just
decide?
there. Well, part of it I think is following them every month, and kind of getting a feels like, all right, this one's generally higher than this one. This one's really generally lower than this one.
Which ones are phoning it in? Which ones are really into the
and there are some aberrations in this report that at first I was like, oh, this is really interesting, and then I thought, oh, maybe they're just aberrations. Yeah. So I'll get into that in a second. But in terms of their numbers, again, nothing too surprising or out of line with apartment lists. They have one bedroom rents up 12.2% year over year, and two bedrooms up 13.83% year over year. That's a recording for the quarter, so they're probably capturing a lot of that summer rent growth.
Did they show 3-bed?
They did not show. It's just 1 and 2 bedroom.
Because we are seeing just in general kind of growth in the larger unit sizes, 2 beds, and especially the 3 beds. And so I was curious about that.
Yeah, I think that definitely makes sense with the 2 beds up more than the 1 bedroom. So apartment list again it measured 10% compared to the 12 and roughly 14% for Apartment Guide. Apartment Guide also has some interesting data on state level rent growth. They comment that states that saw the highest increases in yearly rents for both apartment sizes, both 1 and 2 bedroom, are clustered along the lower Midwest and the Deep South as that part of the nation caught up to broader price trends. Now, I do agree that that some of these Midwestern states are experiencing a little bit of it's just their stability showing amidst a little bit more turbulence in the rental market. But that statement is in the ballpark of being accurate. Yeah. But I see that Tennessee has the highest rent growth at an eye-popping 38.24% year over year. And I'm really hoping that Apartment Guide isn't saying that Tennessee isn't part of the lower Midwest. Tennessee is not a part of the Deep South either. So maybe that's just a little bit of a miscalculation.
Oh, maybe. But you got the Mason-Dixon line right there, right?
Yeah. But I have a map of the lower Midwest, and it's not, and it shows that it's not Tennessee. It stops at Kentucky. Yeah.
It is interesting. I mean, Nashville, has a lot of growth, and there's some other Tennessee markets. Chattanooga. But I'm curious. I'm surprised that it's more than Florida. More than Texas. That is.
There is a little bit of a logic where we are seeing, and what I think are, maybe it's not post-pandemic trends, but there are some trends that are running counter to stuff that we saw last year and the year before. Yeah. And things are different, and things are kind of bouncing back, or they're kind of cooling off a little bit, especially in places like Phoenix. I think I've seen some kind of big cool-offs. This 38% is incredibly striking for the state numbers, and
they've got Phoenix's year-over-year change at 0.65%. That can't be right.
Yeah, well, and that's another thing too, is like that the 38% year over year for Tennessee as a state level, that almost squares with the apartment list's amount of growth for some markets since March of 2020.
Yeah.
So there's
something fishy about these
things
numbers.
are growing. Suspicions are growing. But I think, there are some places in the study, like I said, where the numbers don't exactly square with other reporting. They have Indianapolis with negative year over year rent growth. But in other reports like Yardi Matrix's, which I really like, Indianapolis is among the very top when it comes to month-over-month rent growth, at least in the past month or two. Also, Indy's negative rent growth doesn't make sense in light of the state level rent growth for Indiana, which is at 19% year over year for one bedroom, 14 for two bedroom. So there's these strange discrepancies. Mm-hmm. And also, like, the thing that really started me kind of digging a little more was this weird thing where Michigan's one bedroom rent growth is 0.43%, so very nearly zero, and its two bedroom rent growth is 31.93.
Yeah.
So
I can see that there being more demand for the two bedrooms, mm-hmm. like we were just talking about, and we see on national, but that's that's a big discrepancy.
Yeah.
Like
so
the demand isn't, because at some point someone would be like, I'll take a two bedroom or one bedroom.
So what I think this is, and I could be wrong here, and I would definitely invite, if anyone from Apartment Guide wants to come on here and explain it, I would
explain yourself.
But the methodology section shows that they're getting their numbers from the portfolio of Apartment Guide units. Mm-hmm. So maybe that portfolio...
Well, because maybe explain... so Apartment Guide is like an ILS service, a listing service for apartments. So, apartment renters can find an apartment. Apartment owners pay to be on Apartment Guide. Is Apartment Guide... were they purchased recently? Who owns Apartment Guide?
Rent Group Incorporated.
Tracking down the data. So also they own rent.com, Apartment Guide, because we're experimenting, comparing apartments.com mm-hmm. and rent.com.
And that's another good point too. A lot of these, just kind of behind the reports, Yardi Matrix is the same way. They sell services that, that help people with property management and kind of tracking rents and this, the Apartment Guide and
Redfin.
Okay, all right. So this is a Redfin associated company. That's very interesting. So again, looking into the methodology is important. Kind of looking at what each company does is also important. Maybe sometimes we'll get some from kind of banking or lending organizations. These people there's lots of entries into the report publishing world.
Well, I'm curious then, how much of this is coming from Redfin data. And, a lot of single-family home information, which, again, doesn't really track.
Yeah.
But maybe not as pure apartment information.
I don't know. Redfin's numbers were a little bit more stable than the numbers that we had here. I'll have to keep, maybe next month, I'll keep this on my list and return to it. But again, it was just that discrepancy with the Michigan numbers, nearly zero to 31% rent growth year over year. And the fact that, this isn't the lower Midwest is not Tennessee. So
Apartment Guide got a little bit of work to do. Trying to keep them honest over here.
That's right.
Matt, let's get into this blockbuster report from CBRE talking all about cap rates. This was a highly anticipated survey, mm-hmm. as it always is. CBRE does cap rate surveys for splitting the year in half, H1 and H2. I've been looking forward to it.
Yeah,
bring us up to speed.
It is interesting. People want to know. People really want to know what the cap rates are, and it's hard. They're hard to predict.
Well, and it's lagging. So like a survey is going to be lagging. It's talking about the past. We can use the past to inform the future and
mm-hmm.
look at trends, but things have been moving so quickly with interest rates that we have to look at this is kind of in the rear view mirror. But
mm-hmm.
I'm hoping that we make a couple predictions as well in this and trying to get the crystal ball going.
That's what, and you can kind of correct me, but like cap rates seem to be more of the product of a market than like a rule that a market has to follow.
Oh yeah.
So
there's a lot there. They mean a lot of different things to different people, obviously. And I think to start, what is a cap rate? A lot of our listeners, they use cap rates throughout the day. But mm-hmm. for someone that's maybe newer, might not know what a cap rate is. Cap rate is a capitalization rate. It's a valuation metric that is used to determine a potential value. It's one method to determine the value of a piece of commercial real estate. and that value is relative to the income that it produces.
Okay.
So in order to determine your cap rate, you need to know at least two variables. And you can use this formula to solve for either what the net operating income is for the property, what the value is of that asset, and then what the cap rate is. So you need two out of those three variables to get the third, essentially.
Okay.
So to figure out what the cap rate is, essentially we take our net operating income, which is your income minus your expenses, you don't include your mortgage payment, and divide that by the purchase price or the value of the property. That will give you your cap rate. So if there is a $100,000 of income on $1 million property, 100,000 divided by 1 million, you got a 10% cap rate. Now you can use those variables to determine, what the value is. So you can take the net operating income and divide by the cap rate. So $100,000 divided by 0.1, or the 10%, would give you that $1 million valuation. So it's the main metric. It's not the only metric, because you can also use comparative price per unit and other kind of comparative metrics. But because commercial real estate is traded on how much income it produces or how much income it can produce, that cap rate is incredibly important as a kind of a guide for how to value something. And cap rates vary from market to asset class to submarket to the different side of the street to the quality. So there's always a range, but understanding kind of what that range is incredibly important.
That's what I was thinking. It's like, if you have a cap rate in mind, you can go up to someone and say, but I plugged in the cap rate. It's like, sorry, it's not a hard and fast rule.
And there's no good, and people ask, what is a good cap rate? What is a bad cap rate? There's really no such thing, because again, it can mean different things to different people depending on what you're purchasing and how you're using the metric. You could just use cap rate as a measure of risk. Of a lower cap rate seemingly could indicate that there's lower risk in the market because there's more interest in it and people are allocating more resources to it, until you get to the point where cap rates are so low and you can have some sort of bubble or kind of a misvaluation. Cap rates being high means that you're going to get a higher rate of return, which also means that there should be a relatively higher degree of risk because you're receiving a premium on that risk to make that investment. But also, your cap rate that you buy something in isn't necessarily relative directly to the return, because you're going to have your own business plan. You may be buying a property that's producing $100,000 of net operating income. You're going to fix up the units, increase rent, reduce expenses. So it's going to be creating $200,000 in income over 5 years. Now you're you're running at a 20% yield on cost, or kind of cap rate, although it's really truly yield on cost. So the cap rate that you purchase it at isn't necessarily what your return is going to be, which is the idea of allowing people to buy at low cap rates like we've seen in today's market. So you can buy at a 3.5, 4 cap rate. If the income growth is so high, you're raising rents at such a clip that you're still producing the cash flow, but it just takes time to be able to execute that business plan. So again, cap rate is a lot of different things to a lot of people. It's a capitalization rate, and how we value all these assets and where the market is critical to kind of making some of these decisions. So understanding where that market is today is important. And I would say outside of these surveys, this will give you an idea, but the best way to know what cap rates are in your given market is by talking to people who are in it. So that's lenders, and that's brokers, and that's other buyers.
And that's why I want to say it's like, this is not a hard, fast rule. That's why probably you can't get like a computer program to do it. It's so much in the air, and it's so much having to do with the people that and the thoughts that are happening every single day. You can't keep up with it.
Because there's no really good historic cap rate data. It's very opaque. It doesn't get reported. There's not a lot of public reporting at all. So it's very hard to track. So this is why when you actually get a report, it's why it's so exciting. So let's get into it, Matt. Let's just kind of jump into some of the conclusions in kind of the meat of this report. I think there's some top 5 insights.
So the top 5 insights from this report are that concerns over rising interest rates are fueling expectations for moderate cap rate expansion. A weakening economic backdrops leading to tighter underwriting and lending assumptions. Sturdy fundamentals are supporting milder yield expansion for industrial. Relative pricing is making quality retail attractive, even though it's weaker in marginal centers. investors. And then, while concerned with rising operating costs, hotel investors are optimistic about resort properties and markets in the Southwest and Mountain West. And absent in that report is the fact that, in general, cap rates at the higher end of the market have seen more modest expansion than cap rates for assets on the lower end of the commercial real estate market. And multifamily and commercial have the lowest cap rates. Office properties are at the top cap rate wise, and retail is a little
right in the middle.
It's kind of right in the middle, maybe along the upper end. Either way, it's.
I mean, there's multifamily cap rates in the threes and even mid twos.
Yeah, that's what I was gonna say. Is like it is really dominated on the lower end by multifamily properties, and I think it's people coming in and seeing multifamily as a little bit of a sanctuary, and as you said, like a lower risk investment perhaps than.
Well, I
than
think
others.
the risk is perceived to be lower just because the fundamentals and the thesis is so strong right now.
Yeah, CBRE does note that markets have been more active than would have been expected during turbulent periods, and sales volumes are actually up 10% in the second quarter 2022 compared to the same period last year. Partly, explains CBRE, because people have been trying to get ahead of interest rate increases. So that there is, and we'll see again in the future slides, there is this expectation of interest rate increases that is actually driving things in the market. So the rising cost of capital, that is something that is that's readily apparent. It says that tighter monetary policy has significantly increased borrowing costs, impacting some transactions, and in some cases, debt financing costs have drifted higher than market cap rates. Survey respondents overwhelmingly expect cap rates to increase during the next 6 months.
As we've seen, we've said in the past, there has been a decent amount of negative leverage being used, which I think is a kind of a sign of maybe a little overheated a little bit.
And especially I think that's a kind of a market by market kind of thing. But I wonder if things keep going, if cap rates stay the same or keep going lower and interest rates keep going up and that spread tightens, are people going to start spreading into secondary, tertiary markets and even more than they are already?
I think people are already doing it right now. I think there's going to be some people looking at I think some quality retail, as they mentioned, some other asset classes where you can get a little bit more of a premium, but also some markets that you can get some yield out of that are still stable. Well, then maybe there's a little bit more secondary or tertiary than you were investing in the past as well.
Sorry.
Well, no, I just think, again, I think we mentioned this a handful of times, but, there's so much dry powder out there in investor interest, especially on the institutional side and the international side, that is what really has been able to keep cap rates as low as they are relative to interest rates.
Mm-hmm. Yeah, it's we've said this before. It's like, what's the alternative? And when you're looking at, especially CRE, well, we are looking at CBRE, the multifamily is a great alternative to any other asset class. Mm-hmm. And if you're looking at investment in general, commercial real estate is a great alternative.
Matt, this is just giving some definitions or some more color to the conversation that we were having, earlier in the show of who are the investors and really being the institutional investors. The institutional investors and equity funds, really starting in Q3 of 2021, really kind of throughout, honestly, 21 and through 2022, they've been the majority investor, besides at the end of 21 where we had a little bit of a little more diversity, including private investors, which had made a pretty decent chunk in the past couple of years. But you see, not nearly as many private investors as well as kind of listed REITs.
So
as well.
The negative. So when these numbers go into the negative, that represents someone selling.
Or they're not making as many acquisitions. I think it's not necessarily selling, but deploying of capital, making acquisitions. Okay. So who's buying right now?
So private investors were negative almost $30 billion, much more than institutional investors were. It seems like private investors are going out of the market at an incredible rate.
Yeah, again, those private investors are like the syndication groups that are using higher moderate leverage, where the institutions, they can go with the lower LTV and still get deals done. Yeah, and that's how we've been able to get deals done is using lower leverage, taking less risk, but still getting good returns. And self-fulfilling prophecy, but people are thinking cap rates are going to rise, and so if we will it into existence.
Yeah,
it seems like.
So they say as of late May, survey respondents were largely expecting an increase in cap rates within a 25 basis point range. It's virtually assured that these expectations would be revised upward if the survey were conducted today. So this is only late May. That's actually really interesting. I don't know if it over determines it or but it definitely underlines it that people are really expecting cap rates to rise. And loan spreads are expected to widen as well. I thought this was interesting too, because the following slide also talks about how the lending terms are becoming more restrictive. Are those of the same piece? Is more restrictive loan terms mean that loan spreads are widening? Because it seems like one would go against the other.
I think you can do both. I think you're right. So, but you can have underwriting standards, but still, narrow your spreads.
Okay.
Because you're being more conservative on, what you're going to assume on like the growth, but maybe we're not going to charge as much on the loan. I don't think we have seen the spreads. So if they're going to widen, so that would be tightening. Sorry. So going back, if loan spreads are widened, that would be tightening.
Okay.
Because they're going to be charging more. It's going to be a higher hurdle to clear, again, for that debt service coverage ratio. Because instead of paying the 10-year Treasury plus 200 basis points, maybe it's 10-year Treasury plus 250 plus 300.
Okay. I was misunderstanding. I was thinking of the cap rate spread, the cap rate and loan spread, about what would be the spread comparing that cap rate and the amount that you're paying in debt. But this loan spread is talking about how much additionally each individual lender is going to have
charging a premium, because
okay.
the interest rates that a lender charges are based on some kind of index rate, which is again typically SOFR, the 10-year Treasury. Plus a spread, which is sort of basically the profit that the bank makes, for their risk. So again, that's typically, so however many, percent on top, 2%, 3% on top. Widening is going to increase that amount of basis points percentage that they're going to charge as their profit because of perception and risk. They see more risk in the market to make the investment. They need to be compensated for the risk, essentially.
Okay, that definitely
is the
makes
concept.
sense.
So no, those two jive for sure.
And now the next slide is. Oh, I'm sorry. Multifamily underwriting, it reflects higher cap rate assumptions. But then there is a slide coming up here that talks about why. Why are cap rates poised to rise? And I thought that I'd like you to explain it if you can.
So, rising interest rates, I think that makes sense. Expect higher cap rates is why cap rates are poised to rise. So again, this is the self-fulfilling prophecy of, hey, we think we're going to... I mean, it makes sense. If you think prices are going to go down, you're less willing to pay today's current pricing because I'm going to wait for them to come down. And those lack of buyers, or those fewer buyers who are now on the sidelines,
and that
drives prices down, or at least does not drive prices up to a point where we're seeing continued cap rate growth. And I think there's a point to be made here that, again, while cap rates and prices are obviously correlated and linked, cap rates aren't the only variable in the equation. Again, let's go back to this cap rate equation and formula, net operating income. Yeah. So you can have a slightly higher cap rate, but if your income is increasing at a very fast rate, you could be seeing pricing stay the same. Your price could stay the same, but your cap rate rises. Or you could even see your price increase and the cap rate rise, and your cap rate rises. So cap rate does not mean valuation. It's one of the tools of how you're valuing that income. But if the value of that income income is increased, there's not a one-to-one movement of cap rate and pricing necessarily. So that's what we're going to have to really
that's
watch.
interesting.
And so you may see those higher cap rates and say now it's attractive.
Yeah.
But because a month ago, let's say 6 months ago, you're saying, no, I only want to buy something at 5 cap it up. You see a property down the street and the owner says, it's worth $50 million, but that's like a 4.5 cap for you. Well, 6 months later, maybe all of a sudden the income has increased, rents have been increased. Now the cap rate on that property is a 5%, but he still wants the $50 million, so he's getting his price because the income's there.
That's really interesting. And so one of the reasons why people think that cap rates will go up is that they're pricing in weaker NOI growth.
Yeah.
That's,
then you could really see cap rates.
But
expand.
when I'm thinking it, and what you were saying before is like I'm kind of thinking about inflation. And if you're, cap rates should probably price in a little bit of inflation if that's going to impact NOI growth, and that runs a little bit counter.
Well,
to
this is
people's
this is like
inflation.
25% of people basically saying they think that inflation is going to taper off and rent growth is going to moderate significantly, which I think that most people would agree. It's just the question of when.
It's finite for sure.
Yeah,
that's really interesting. I just thought the self-fulfilling prophecy is one of the most typical.
It's like a recession, indicator of like, do you think there's going to be a recession? Why? Well, it's because everyone else thinks there's a recession.
Yeah.
So, then there's some information on the office markets. I mean, quick conclusion: office markets I think are still uncertain. They're under pressure right now.
The retail thing is really interesting, and I was reading some other articles that really showed how there is some potential in the retail space, and I think it's also dependent on retail wasn't performing too well last year or the year before, but it also wasn't cratering, and I wasn't seeing the really like this dark future for retail that some people thought. Initially, after the pandemic, it was quickly apparent that retail had a chance to survive. It's not going to be in the same place as it was. I think that malls aren't really doing as great now, but retail, but there are deals there, and there could be a real opportunity for investors.
I think it's so location dependent in what it is and where it is that I think you can find some great retail opportunities that are, I think, relatively low risk if you understand the market and the operations. And there's some other retail that is, highly risky, and it'd be a lot of brain damage and wouldn't be worth it. So I think if you know your market, the business and how to operate it, I think it could be a great opportunity right now.
And again, this is only like bird's eye view, and I do not have the experience in the retail market to know where the directions are. But some of the comments from CBRE and some of these other reports are indicating that there's some real growth potential for retail.
As they say here, retail is interesting.
Retail's interesting.
It's interesting.
I love these headlines.
Aren't you? Isn't this your business? Like, I would hope that it would be interesting. Hospitality, higher hopes for leisure travel hotels. I have higher hopes that hotel rates will be cheaper, but I don't have a lot of confidence in that being the case.
Not. Yeah.
No. Where would hotel investors like to invest during the next year? Do you think that hotel investors, I guess there's an overlap of like places I don't invest in hotels, not because I think they're bad investments, just because I just don't understand the operations enough. But, you would think an attractive piece of it is, you can invest where you'd want to actually go and visit, although they don't have to line up, but a place that you'd want to go visit would also probably be a good place to have a destination hotel. So that when they pose this question, where would hotel investors like to invest during the next year, is this also like where they want to go?
Yeah, it makes sense.
Right.
Popular tourist destinations.
So it sounds like a lot of mountain towns are really becoming popular. Between Jackson, Salt Lake City, Flagstaff, Sedona, Colorado Springs, Mount Napa. A
lot of these were the places that saw the insane rent growth in 2021. Phoenix and Tampa.
That's a good point. You think there's been a lot of backlash on Airbnb because they've gotten more expensive, and the hosts are often very restrictive. Hey, I have a noise monitor, and if you trip it up, there's going to be a $3,000 party fee, and just these kind of house Airbnb Nazi hosts essentially. And there's been a lot of people who are like, wait a second, like you're like aggressively telling me I need to do all the dishes and to make the bed, and don't be loud and don't do this, don't do that.
Seller's market.
And you're charging me a lot and all these fees, or I could go to a hotel where they actually give me good service.
Yeah.
Again, I love like renting houses. Like there's time and place for both, but like when you look at the service and the experience, I think a lot of people are appreciating the other services, amenities that hotels offer, And I think maybe last year in the pandemic, people did a lot of Airbnbs in these kind of more rural, mountain, kind of nature destinations. And they want to go back and they're like, well, maybe screw the Airbnb. Let's just get a hotel.
Yeah, that's really interesting.
So a lot too many dots to connect?
No. It's almost like it's like a short history of how hotels were invented. Well, yeah, we can't stay at Joe's house. Joe's got all these rules. Let's just build a house that's specifically let's just build a place.
Well, and sometimes I tell folks that are into Airbnb, and I think like it's a really cool model, and it's it's not something that I do. It's just putting the systems in place.
Yeah.
But what I tell them when they're really getting into it, I guess it's not an issue, but at some point you have to acknowledge that what you're doing is managing a scattered site hotel or scattered site hospitality service. And I look at it the same way I look at single family home investing and multifamily investing, where it's like, that's a lot more work.
Let's just put it all on one, put them on top of each other.
Like, what if we got all these Airbnb houses? We put them in one building, and then we had one restaurant we could sell them food, and we could provide them really good service, and they have one really nice shared pool and a place you can get like a massage. So is the goal to buy a hotel? I don't see very many Airbnb operators making a switch to buying a hotel or developing a hotel, which I think that would be the logical next step.
Yeah.
Because how do you not understand you're in the hospitality industry and look at what all the options are in the hospitality industry?
Yeah. Now, I think that there is, just like there is unique reasons why people would want to rent a single-family home versus 100%. An apartment. Yeah. So kind of those same reasons. But, man, if you're looking for a deal, it may not be a deal at Airbnb anymore. Yeah. Because people are probably realizing, the neighbors are starting to bug me about the noise and parties. Yeah. And now, I used to do it really cheap, but now after a couple years, I realize all of my appliances are getting wear and tear, or these other maintenance issues are cropping up. I was like, oh wait, there's a cost.
There is a significant cost there. Yeah. I thought that this was an interesting part of the survey. The perception of risk varies by property type. So, and this makes sense. They're breaking down the different types of property type and, how much risk are average. It's basically ranking. Investors are ranking the risk for each property type and the risk factor. So interest rates rising too quickly and too high. Matt, you're going to have to help me with these colors.
Yeah, even I am a little bit confused because the color for multifamily blends in so easily with the background of this chart. But
are they just saying there's no real risks? Is that like a
maybe that is.
There's no risks and everything, but they're basically saying we need to mention them. But
so as far as I can read it, the idea that interest rates rising too quickly and too high ranks at number one for all of these. Property types, and people in the multifamily space. Oh, I'm sorry. It is a slight yellow. People in the multifamily space are most concerned about interest rates rising too quickly and too high, and hotels are among the bottom. Really, the only place that hotels aren't at or near the bottom is the significantly higher operating costs. Yeah, which has got to be huge.
Way up there,
and that's something that we haven't really talked about yet. But maybe next week I'll find an article that'll reflect.
Yeah, we should talk. Yeah, and we have some of our own data and. That'd be a good one to get into. And I assume that's the interest rate issue is just they can raise rents. I would think that would also tracking inflation would help on the operating costs. But that payroll wages I know is hitting the hospitality sector very hard.
So the second factor is weaker economic backdrop, followed by tighter lending standards that we talked about. Again, and the operating cost is number 4. Weaker rental income is the ranked fifth. And intense competition for assets eroding anticipated IRRs is at the bottom for all of these. Again, this is it really is dominated by interest rates. I think the weaker economic backdrop is a little bit tied into that, but the significantly higher operating costs is something again.
I'd like to really talk about that. Yeah, that's a good topic for I think a future episode we can really get into some details. Well, there's a lot of other good stuff in detail on this report, so I'd highly recommend, one, signing up for the Gray Report newsletter. You can go to graycapitalllc.com/newsletter. You're going to get a very detailed investment brief every single Thursday morning at 8:30, packed full of all the latest research reports, articles, another good content from Gray Capital and elsewhere. But you got to make sure you're signed up and subscribe, though, to the Gray Capital YouTube channel. Hopping over to YouTube, assuming you're watching that on here, or if you're listening to the podcast, we appreciate it. It's good to be on both, though. Get the podcast and get us on YouTube, so then you get the whole video feature. You can watch us talk about
Start watching in your office and then finish it on your drive home.
It's a good plan. And lastly, if you're an accredited investor, we've got a couple deals in the pipeline at Gray Capital for the Gray Fund. So hop on over to gray.fund to learn more, get the deck, and schedule a meeting to discuss it with us. All right, Matt, this is a great report. Great set of reports. I hope everyone's learned a little bit. I know I have today, some more insights. We're going to be back next week, as we are every Thursday, with the Gray Report.
All right. Thanks.